morning. My name is Asra, and I might be a bit jet lagged, so I do apologize for that. We've been flying for a while. So thank you so much for coming here today. It's always really exciting to hear and meet the entrepreneurs, but it's even more exciting to always meet and hear from the people who actually have the money, because we're going to be there to help change the world that everybody talks about. So just a quick show of hands. How many of you have made more than 10 investments? Okay, good. How many of you have made more than 5 investments? How many of you have made no investments whatsoever? Okay, awesome. You guys are my favorite people ever because you haven't made any investments, but you want to, so that's always a start. Okay, so when I do my talks or presentations or workshops, I usually don't I talk a lot, but feel free to ask questions at any point in time because I want this to be as helpful and interactive as need be. So just a quick background about who I am. I'm originally from Pakistan, and 2 of my companies were funded by Tim Draper, and that is how I knew of him. One of them was acquired. Right now, I'm a partner at our early stage fund. It's called Draper University Ventures. We invest in early stage companies that come through our own program. We actually haven't made any investments. We literally just started. But for the last 4.5 years, we have about 400 active companies that have come out of Draper University. They've raised north of 80 million in seed funding, and we now have our first unicorn as well. And we have 7 in Forbes 30 under 30. So Draper University essentially started as an experiment because Tim Draper, who's a legendary VC, you'll hear from him in a while, he thought, well, a lot of people are not really, entrepreneurship can be taught, and people were like, no. And then he wanted to start a school, and we hate everything traditional. None of us at Draper University are about corporate culture, tradition. So we kind of flipped the model around. So whereby you were supposed to study history, we teach future. You're supposed to have teachers. We have none. Actually, every single thing that we teach at Draper University is taught by industry experts. So if we're going to talk about building rockets, we're actually going to bring somebody from Tesla or SpaceX or one of those people to come and talk. So that's kind of our background and what we do. So just kind of to give you a brief of what we're going to be talking about, we're going to talk about what angel investing actually is, how do you start, and where, because of my background and how we've been working in emerging markets for quite a while now, we see a big gap, and how can we fill that gap through syndicates, where not one person or one company is wasting their money, but everybody pools together. Then how do you create your angel brand, and assessing opportunities and post-investment sites. So very quickly, what is investment? What do you guys generally think investment is? I know, you have to answer questions, guys. Come on. I know, it's 9:30 in the morning, but what do you think investment is? Anyone? Printing money? That's how entrepreneurs see it. I know. Yes?
It's giving money to someone that will spend it better than you.
That's actually a really good answer. It's actually, what his answer was, it's giving money to somebody who would spend it better than you. Okay, yes? Purchasing the future? Expected return? Yes. There's somebody here. Did you have an answer? Oh, you didn't. Okay, so that's essentially what investment is. Investing is when you take money, it could be your own or somebody else's. When you take that money and you put it into anything, you don't necessarily have to invest in entrepreneurs, you put that money into something expecting a certain level of returns. Now with entrepreneurship, these returns can either be really, really high or scary, and we'll talk about that in a minute. But what angel investing is essentially the first leg of investing. You guys it's called angel for a reason. What do angels usually do? We all have angels in our religions, right? Or our cultures. What do? They help out, they tell you lullabies at night, They hold your hand. There's a tooth fairy. So that's kind of what your role is. You're not only giving these entrepreneurs money, you're also holding their hand. So it's a very, very tough job, which is why not a lot of people are ready for it. So let's talk about how can we look at the ecosystem. So essentially, this is a brief, and I can share my presentation. I love when people take my pictures, but if you want the presentation, feel free to get it from me. So I'll go upwards, right? So what a growth Series B fund is essentially a fund that invests millions of dollars, so anywhere from 100 million plus in companies that have revenue, companies that are on the path to an IPO. So they have customers, they're on a growth trajectory, and they're on their path to an IPO are called, those are usually Series B funds. They're usually corporates, equity funds, very low risk, but high capital, because, I mean, I don't have 100 million to invest, but that's kind of where they are at. Then we have Series A funds, which are your early stage funds. The check size is usually anywhere from 5 million and above. And again, the companies that they're investing in are slightly risky, but because they might not grow as fast or another competitor might get in money. But again, these companies have been highly de-risked. So the return is still about 10% or something, but not that like wide awakening. Then there are bridge funds, which are again your early stage funds that help give people kind of bridge capital, early capital, and again, their check sizes are also anywhere in the early millions, single-digit millions. Seed stage funds are where, again, you have a product, you have a customer, at least one customer if you are a SaaS product, or you have customers or users using your product and you're on a growth trajectory. That's where your seed funds come in. Angels, however, on the other hand, are people who come in with the earliest stage when you only have an MVP or when you only have a single, like a promissory note or a few people using your product, so you're still very, very early, whereby the check sizes are also really small. So when you write a check, you would write a check anywhere from 25,000 to 150,000. But you're taking the bulk of the risk, but when your money returns, it's usually anywhere from 300 to 1,000% of the return. So to give you an example, one of my favorite angel investors is Jason Calacanis, who invested $25,000 in Uber for 2%. So that is the kind of returns that your Series B companies would never see. So for example, now that the new Chinese fund, I'm completely blanking out on the name, is coming in and investing in Uber, their returns are not going to be as great as that. So that's like a very common example. Now, one of the biggest problems here in our emerging markets is that entrepreneurs, angels, everybody thinks that this stage is when you have an idea. So for example, I wake up one morning and I think of a company, I should go raise money from an angel. That's not true. One of the things that I always tell people is nobody gives you money till you've proven something. So as an angel, your job is not to give money to people who only have ideas, because that's where everything before that comes in. So if you go to an incubator, you could go with an idea. If you go to an accelerator, you can go with a minimal viable product or something that's there. You can go crowdfund. So if you want to build the next big phone that you think everybody needs, go crowdfund for it. Or ask your friends and family and put your own sweat equity. What's sweat equity? Anyone? It's not your own money, actually. Your time, your own sweat. So when you actually, I don't know what the term for it in Arabic is. I know what it is in Urdu and other languages. But that's essentially where you're actually sweating over it. You're figuring out how to find a job, how to do this, and you really want to solve a problem. That's sweat equity. And that is not an angel's problem. That is not an investor's problem. So when somebody comes to you, make sure they have a product. If they're coming to you with a napkin in hand, sorry, this is not a product. So this is just kind of a timeline to show you where money should be going. And another big differentiation between angels and early stage funds are two separate things. So corporates that want to invest early stage are actually not angels. They are early stage funds. Angels are single people who want to put their own money into these products. So let's just quickly find out right now. How many of you think you're angels? Okay, so you guys are angels. How many of you are early stage funds? Cool. There is no hybrid. There isn't. So the minute you actually take two people's money, so the minute even two angels combine together, they become an early stage fund. And the reasons are actually pretty great. So what happens is that if you're an angel, it's your own money, right? Every single return that you get is going to be your own. But the minute you combine your money with somebody else's money, then there's a particular financial structure that you have to follow. And you may, as a general partner, for example, if you now become a GP, you will only get 20% of the carry, and then everything else gets distributed to other people, right? Yeah. You can always invest yourself and as a group, but that's kind of where it gets tricky, right? Because then it's a conflict of interest. What would you keep for yourself, and what would you give to somebody else? And I would never invest with, like, if, for example, I'm a fund, I want all of my partners to work for me and not invest on the side. Yes, then you can definitely do that, definitely. So if it's separated by industry verticals, then you can definitely do that. Also, as an angel, you decide how many deals you want to do. So let's say 1 year you're having a really good year, you do 5 to 12 deals a year. But as an early stage fund, your money is locked in early. So there's only so much that you can do with that money. But on the flip side of it, the good side of it, as an early stage fund, you're more structured, and because you have 2 or 3 people vetting the process, you're slightly de-risking it, but that's pretty much about it. So now, why do you angel invest? Why give money to people who don't have any traction? Why take all the risk? And why even do it? I know the answers are here, but any ideas apart from these? So one of the biggest reasons for this is, for example, I live in a country and I see that education, governance, finance, all of these, let's say these 3 things need to be drastically changed. If I'm an entrepreneur, I can only work on one problem. But if I'm an angel investor, I can actually find people who are working on all 3 of these problems and help change and create a bigger impact. Also, the returns are amazing. So those 2 are pretty solid reasons on its own. But apart from that, you also become a part of the ecosystem. You become the person that people go to for change. So one of the things that we see here happening is that when people angel invest right now, what they're looking for is de-risked investment opportunities. As an early stage investor or as an angel, there is nothing that is de-risked. You can have industries that you might think, for example, fintech is huge in emerging markets right now. Mobile is a huge opportunity. Copycats are a huge opportunity. Healthcare is a huge opportunity. But even within that, any money that you're going to put in is going to be very, very risky. So impact should be a huge part of why you're doing this. If you don't feel that you're the person who can make this impact here, and it's kind of something that you would say to your entrepreneur, if you're not passionate about this, don't do this. I would say the same thing to you. It's your money. If you're not passionate about the problem that you're investing in, don't do it. It might not work out the first way around. So the official requisites, for example, to be an accredited investor in the US, you need to have about $1 million, $2 million in net worth, and you also need to have, if you don't have that, then you need to have $300,000 that you've been earning for the last 2 years. So all of these things are created to protect the rights of the people who are putting in money. But again, these are different. But the most important requisite for this is that you need to have a long-term view. How much time do you think it takes for your first investment to see through, or to get any return on your first investment as an early stage investor? 1 year? 10 years? Yeah. What else? 3 to 4? It takes anywhere from 10 to 15 years for it to get to a point where you're actually going to see any return on it. Also, since you're taking ownership of the most risky part of entrepreneurship, industry standard is 90% failure rate. And this failure rate is even higher in emerging markets or in new markets because there isn't enough education between both entrepreneurs and investors. So while there is capital readily available in emerging markets, don't invest unless you're ready to kind of lose that much money. Also, if you're an angel investor, what's a good amount of money that you should put into companies? Any guesses?
Just enough to start, not too much.
How much of your own money? I know, so just enough to start, you're putting 10,000 or something, but what percentage is that of your income? Less than 10%? What else? 10 to 15, yeah, so that's the right answer. So if you can put aside 10 to 15% of your income and your savings for the next 10 years, only then do it. Don't do it if you want to buy a house next year. Like, buy a house next year, right? Okay, so how do you start? Where do you find these companies?
To that point, they have to, usually the problem that I see with angel investors is they don't think about the follow-on investments that they're making, because if you start, say you invested $20,000 of your money, but that company will be raising additional funds, and it's very important to look at that, how their cap table looks like, how much capital are they going to need up until they get to that point, and they have to budget to keep their interest, because otherwise you're throwing your money out the window, I would say,
That's a fair point. I kind of don't agree with it, and I'll tell you why. So what she's saying is that as an angel investor, one of the things you need to think about is having money for follow-on rounds. Now, let's say I'm an early stage investor, right? If I'm a very rich person, I make $1 million a year. I'm keeping 20% of that aside to invest in companies. And I really see 3 or 4 opportunities that I want to invest in that I'm willing to work along. I alone cannot solve this problem, which is why it's very important in the entrepreneurial ecosystems for everybody to work together. So for example, angels or early stage capital, it's not enough money to take on the responsibility of early stage investing, follow-on rounds, everything. People are very scared of sharing good deals for some odd reason. That should not be the case. If you have a good deal, share it with other people. That's how Silicon Valley started. That's how any good entrepreneurial ecosystem starts. You invest in them, and then you open it to other people. What you're doing is you're de-risking yourself, and you're also creating an environment where entrepreneurs thrive. And you'll make more money in the long run. And then once you have that going, and your money starts returning, then you can start doing it in follow-on rounds. Or
yeah, we could have that conversation. This is
yeah,
a long story.
exactly.
It's diversifying your portfolio is definitely good for you. All I'm saying is it's maybe wiser to put aside a certain amount that you're willing to invest per year, for instance, so that you could, you have the budget. You're not going to go in with the VCs, but if, for another round.
Exactly, that's a different investment philosophy. What we believe in is kind of what we tell our entrepreneurs, that you should be very focused. Be able to invest, you have the money to invest, you don't have a plan to buy a house or a boat, and you're mentally prepared to invest. That's another very important thing because it's scary and it's a lot of money and it's a lot of work at an early stage. You have to work, you have to meet these entrepreneurs, you have to help them solve problems, you have to hold their hands because while they're building the company, it's also, if you don't put in some of your own sweat equity into their success, the likelihood of the company succeeding and the likelihood of the ecosystem succeeding goes down as well. So there are two types of deal flows. When we start talking about now that you have a fund and you have money, you have two kinds of deal flow. One is your non-proprietary deal flow. So this deal flow is actually open to everyone in a market, and there is a lot of competition for it. So for example, if you go to a startup conference, every single person that you meet at that startup conference has other investors that they're meeting, right? Sorry, I know you're all here and I shouldn't be saying that. But again, great place to meet people, but you have to understand that this isn't your deal flow. By the end of the day, these people might get a better deal from somebody else or better terms from somebody else. And you might have less options to choose from. But if you're starting on, then this is a great way to meet people. Similarly, accelerated demo days are a great way to meet when you're starting off in your fund. And then you can go online, on AngelList, Crunchbase, etc., meet these people, and find this deal flow. Initially, when you're starting, this is a great way because you're still building your brand as an investor, and you're building your brand as an angel, so you should do that. And the second and the most important part is the proprietary deal flow, and these are the deals that never see the light of the day. This deal comes to me because of my brand. So this person knows that I am a great angel investor and I'm very interested in education and fintech. So this person would not go anywhere else but come directly to me. And this is where kind of I would tie it back to my previous point that I was trying to make, is that I might not be the only person able to fill the round or something. So now if I have a network of trusted investors, or if I'm willing to share my deal, that is where I can bring in more people and actually very quickly close this round. So this is where you should be working towards in the long run. So if you look at your deal flow today, and if you want to be a really good investor with longer returns, this is what you should be targeting. And 70% of your deal flow should be proprietary. It should be coming to you first. You shouldn't be looking out for it. But to get to this point, you have to first build your brand. And how do you build that brand, or how do you become that insider? One of the things is that you make an angel syndicate. Are there any syndicates in Turkey, for example? No, right? Okay. Do you guys know what a syndicate does or is? Yeah? Okay, cool. So I'll just give you a brief background of what an angel syndicate is. An angel syndicate is essentially like a fund where a whole bunch of people put in small chunks of money, and it becomes an early stage. It's a syndicate because you don't have to be an accredited investor. There's some different terms about it, but it's essentially a group of angel investors investing together. One person who has really good market reputation, a really good brand, takes the lead on this. And what that does is that, for example, as an early stage investor, nobody knows or cares about who Asra is, right? So I'm still building my brand. But if I join an angel syndicate, the work is already done for me because the good deals are coming to them. All I have to say is approve those deals, the ones that I want to invest in, and quickly, in a year or 2 years, build my profile. Because just like the entrepreneurs need to show customers, investors need to show companies on their profile. So syndicates is a great way that a lot of emerging markets are exploring, and if they're not exploring, need to explore for early stage markets. And what that, again, it kind of helps you jumpstart your network, build your reputation, and you also get a chance to build relationships with other investors. again, you're using your money, you're using your time, but if you don't like an investor who's a part of a syndicate, you don't have to work with him in the future when you have your own deals coming to you. So how do you pick a syndicate? So for example, if somebody in this room decides tomorrow that, well, I like this idea of a syndicate, I'm going to go start a syndicate, and asks you for money, you should be looking at that they have at least 2 people that they've funded. They've funded at least 4 to 5 companies, they have a track record, and then when they give you a deal, look for at least 2 founders, because early stage, a lot of things happen. People quit all the time. 2 friends meet, they love an idea, and then one of them decides not to do it. You waste a lot of money. So make sure you have at least 2 founders in that, and they have a product and service that is already in the market. In a syndicate, as an early stage investor or an angel, don't invest in anything that's not already in the market. They have at least 6 months of continuous growth, or they can actually justify whatever growth numbers they're showing you. And then, once you're in a syndicate, it's like working in a team. They're not doing you a favor. So follow up on all these leads. Follow up with your lead syndicate person. So whoever's bringing these leads to you, if you don't hear from them in a month or so, don't be scared. If you go somewhere and you meet somebody, bring them back to the syndicate lead and say, hey, I met this person, he's great. Do you want to review him for the syndicate? What that does is that now slowly and gradually you start building your own reputation in the market as well. So corporates are also getting into the syndicate model where you're like, wow, this is competition. I don't really want to work with these guys. But if you think about it long term, strategically, if you're a corporate, you start finding people that align with you, be those governments, be those universities, be those local companies, and then form an angel syndicate with them. Small amount of money, greater returns, highly de-risked, because it helps you do this. And now, once you start seeing these deals come in the market, one of my favorite things to do is fantasy investing. So how many of you know about fantasy football? Right? Okay, so fantasy investing is essentially the same thing. You look at a product in the market and you say, well, I'm going to follow it for the next year and a half to see how the returns are on it. So in your head, make up a number. You don't need to invest any money in it. It's a great exercise to see if you're even ready for this. And I did that for 2 years for all of our Draper companies, and I was wrong 95% of the times. And these are already pre-vetted people and companies. So it's a great exercise to learn if you're ready to start investing in people. All you have to do is come up with like a number. I'll have $1 million that I'll invest. If this person came to me, I would invest this much. Don't do it once they're successful. Do it when you hear about them, when they come to you. Great places to look for, product hunt. Go on Product Hunt and look at companies that are just coming up and see if you would want to invest in them. And then follow them through a year and a half to see how that goes. Also, Angel List is a great place to look for such deals. So look for them, fantasy invest in them, and then write deal memos. Deal memos are very, very important. How many of you have ever written a deal memo? Great. I know. How much time does it take to write a deal memo? How much time does it take you?
Based on the deal, it's good. Hour-based.
Hour, okay. You're really good at...
No. Based on hours, I would spend at least, if it's a good deal memo, maybe 20 hours at least.
What about you, sir?
Around 20 hours, yes.
Okay, so it takes anywhere from like 5 to 10 days to write a good deal memo, because you have to do a lot of market research. So just like the entrepreneur needs to know why he's working on this problem, you need to know why you're investing in this problem. So once you start doing that, there's a lot of, initially investors didn't used to publicly post their deal memos, but a lot of partners at Greylock, at Draper, different various Sandhill Road investment funds now have their deal memos available online. So go look at those deal memos. Everything is a perfect rosy road in hindsight, but look for the ones that didn't work out because that's where all the information is. So launch your brand and your network. So one of the things that I have seen a lot of people do is that they're talking to a founder and they're on their phone. As an angel or as an investor, you're building your brand. Present that brand. As a person who has a lot of money to invest in, look like that person. So when you go into a meeting, when you engage with startups, sit with them, talk to them, do your research on them, put your phone aside, and if you've given them 20 minutes, be there for them for those 20 minutes. Listen to them, follow up with them, do every single thing that they need so that even if you don't end up investing in them, when a friend of theirs is building their company, they would send them to you. So that's a very, very important part of building your social currency. And then there's some things that you need to figure out. So just like I always tell entrepreneurs to do their homework before they go to a meeting, you should also do your homework because your time is very, very valuable. So find out why you want to invest in this. Why do you want to, and even when you're meeting other investors, right, or other angels, ask them, why did you invest in that company? Why did you, how many of you know somebody who invested in Kareem? Okay, so ask them why did they invest in Kareem? What was it that they saw? And that is also something that would help you evaluate your own assumptions around it. Also, follow up. Even if you're meeting another angel investor, another group, it doesn't hurt to send a thank you email because next time they have a deal, your email might just pop up. A lot of times, so for example, we see about 50 to 60 pitches every week. Out of those pitches, sometimes we're not the right investors, but we do forward them along to other people. But honestly speaking, I really wish I had a database, but I don't. I only remember people who, I actually have a database, I just don't use it. So I actually go for people who I have personally dealt with, who I know even if they didn't invest, were nice to my founders. So building these strategic relationships, even if they're corporates, if, for example, I see somebody who might be a great corporate client, corporates are more willing to listen to you when you send them a company if you have been nice to them. So it kind of works both ways. Nobody's doing anybody a favor. Everybody's in this for the long run to make money. And then when you're doing this proprietary deal flow thing, it's very important to just send a small email to people to make an introduction to fill the bridge gap. And if you're just in a network of angels, just send them, hey, any new leads, or did you say any cool company, and I want to look at it. And when you're meeting founders, it's very, very important to look into their backgrounds, review their product, even before you meet them. Have questions ready for them. Just write them down on a notepad, because a lot of us are very busy, right? And what we do is that we set up back-to-back-to-back meetings. So every half an hour, we're meeting somebody. Don't do that. Even if you're meeting somebody for half an hour, give 20 minutes to the entrepreneur and take 10 minutes for yourself to research before they come in. Because the worst thing you can do if you're starting off is go into a room not knowing what the entrepreneur is going to talk about. Again, you're building your reputation, you're building your brand in the market, so it's very important to have all of this information at hand. And then, what are you working on? Why are you working on it? Why are you working on it now? What is your unfair advantage? Have answers to these 4 questions yourself. Even before you meet an entrepreneur, you'll be surprised. Every single time I've gone into a meeting knowing that I know the answer to this question, and an entrepreneur has surprised me with something that I didn't think about, that has been a great investment to make. Or that has been a great entrepreneur to get to know. So ask these 4 questions to yourself, and also leave these questions open-ended. Let the entrepreneurs love talking. so let them talk. And if there are any pitfalls, they'll fall into them themselves. So let them do that. And then 5 technical questions. Tell me about the competition. How are you going to make money? How much are you going to charge customers? Why are you going to charge that? How much does your average customer spend? And then the top 3 reasons this business might fail. I think the last question is the most important. Why is this business? Give me 3 reasons this business is going to fail. It not only catches a lot of people off guard, it also shows you that this person has done some sort, he has some plan B, he's thought about it, he's in it 100%, and he kind of knows that if this fails, why would it fail? And then how is he ready to deal with it? Again, the meeting, other topics you can talk about are market size opportunity, use of funds, and other investors. So this is common red flags, and I'll come to this right away. We're the Uber for pets. Okay. How is that even a category? So if somebody comes into you, a lot of accelerators, a lot of people teach this to entrepreneurs, have an elevator pitch, and go in and say things like, we are going to be the next Facebook, or we're the Facebook for your grandmother. Things like that are, again, you need to be, I know, I understand why tangents are important, but ask them questions beyond those tangents. We have no competition. Oh, no competition. That usually means that they haven't done any research. I at least meet 5 people a day who have no competition. And I always ask them, why do you think you don't have any competition? Or in some meetings where I've been really annoyed and haven't followed my own advice, I've even taken out my laptop and looked for competition for them. So again, while I'm trying to build my brand, I want to be this person who helps them. Because while I might not invest in this company and think this company is really, really stupid, they might start a good company 20 years down the lane. And if I was the person who helped them then, they might remember me. And things work in miraculous ways in investments. So also, a very common sentence, I don't know how common it is in this part of the world, but in Silicon Valley, it's very, very common. I need to know right away. Okay, no. I mean, don't say no, but people who need to, and this is, again, something that accelerators are teaching startups, and this is something that we feel enables both entrepreneurs and investors in making bad decisions. If you really need the money, both the entrepreneur and the early stage investor need to do their homework, and they need to know why this is the right fit. If you need to know right now, you're rushing me and I'm rushing you. Also, this is a very small group, right? So if somebody says, Tim Draper is already committed, send Tim Draper an email. Hey, Tim, I just met this one startup and they say you're committed. Tim might, 90% of the time is going to say, no, I'm not committed, I just met them yesterday. So a lot of times startups say things like that, and these are all red flags. Or they might come to you and say, Telenar just signed up as a user. Okay? It takes months for these deals to work out. If you started your company or your product was launched a week ago, the likelihood of Telenar being a corporate user is really slim, but pick up the phone, do the work, and find out. And if you find out that it's not the case, do send them a polite email to let them know. Also, argumentative founders. So for example, and this is kind of a gray area, right? You want to work with somebody who can defend what he's doing, but at the same time, you don't want to work with somebody who's a pain in the butt, who's always who's arguing for the sake of it, and a lot of entrepreneurs do that. So try not to fall into that pitfall of just like arguing for no reason. And then lack of market statistics, right? What is your competition charging? What is other people charging? You will see a lot of companies that are being pitched to you are a feature. Don't invest in features, invest in products. If it's a feature that somebody else can very easily add, as an early stage investor, I would be very, very, again, take what I'm saying with a grain of salt, because that might be a great company that gets acquired. So it might be a great acquisition target as well. But is it that big a difference? In those, for example, if somebody came to me and said, well, we have a picture, so Instagram, for example, is a great example, or video streaming apps got acquired by Twitter, by Facebook a lot in the early stages. Usually these are acqui-hires, or these are just small, they're not really buying the company, so you don't really make that much money. So think about it, think about the path they're going at, and if it's a feature, make sure they have a lot of growth. So they're on a hyper-growth trajectory to make it an interesting acquisition target. And then once you're deciding who to invest in, again, we try to simplify it. Why has this founder chosen this business, and how committed are they to it? So for example, if a founder comes to me and says, I want to go back to college in 2 years, I might be a bit skeptical, actually more than a bit skeptical, because I don't want to work with somebody who's still thinking about, founders should be all in just like you are. And what are the founders' chances of succeeding in this business and in this life? Ask them questions about what they've done. One of the things that I always ask people, and it kind of throws them off guard but helps me understand them, is tell me about your last relationship. Or what has been your longest relationship? And I'm not saying judge people on who they date, but ask them, oh, great, why didn't it work out? What happened? And you'll learn, because again, they're not expecting the question, they're not ready for it, or even ask them about their family, how their relationship with their father or their mother is. A lot of these things are, again, very basic questions in order to give you some sort of a background on what they're thinking. And then some of the things that you should be looking at is obviously that they have domain expertise, they have experience, and operational knowledge, so they know what they're doing. If they're just going to take their money and hire a marketing person, please don't give them your money. They should be able to do, in a startup, a founder should be able to do most of these things themselves. Then, do they have passion? Do they have integrity? Do they have commitment? So look for all of these things in people and invest in them. Again, pre- and post-traction startups is a very easy thing. I don't think we need to spend more time on this, but pre-traction is somebody who has no users, but a great product. Only invest in these people if you can help them either find a client, and if you think that this is a great product and you have connections to help them find a client, before you invest in them, show them to the clients that you know. Show them around, shop them around to a few corporates and see if this helps. Things that you want to invest in are functional prototypes, MVPs, products that are either getting beta tested or are in stealth mode. So people are actually using them. Things you never want to invest in are mock-ups, business plans, basic research, and things that are written on paper or back of a napkin. Sweat equity is there for that, so you don't want to be in it. So again, you don't want to be anywhere too early. So a lot of people who write business plans, and this number is actually up from 95% to 98%, because a lot of colleges are now encouraging people to write business plans. 95 to 98 of those people never actually see those through. So don't invest in a business plan unless, it has to be a miracle, but don't. This is usually a good way. This is how I chart my investments. So I would just write the company name here, their rating, so I have a mental rating, and why I'm going to invest in them or not invest in them. People that I want to invest in, I definitely meet them a second time around, and let's say I didn't invest in somebody right now because they were too early. I would meet them about 3 or 4 months down the lane to see how they were doing, and then write my comments there, and then I would see how they're doing 6 months out. So like I was saying, fantasy investment, I use this same format for fantasy investment and for real investment as well. Every single person that I meet, I track very easily here. and it helps me. And when you're writing deal memos, again, we've talked about deal memos before, but why are you going to invest? What do you think the risks are? And these are mostly to help you more than anybody else, but it's really, really important. Being an angel or being an early investor does just not mean that you're giving out money to people without thinking about it. You are the one who's doing the most work, and especially if you have other people's money involved, deal memos are a great way to justify why you did something. Never say, no, I'm not going to invest in you. Always say, not yet. You're not ready yet. Please stay in contact. Send me an email. Send me an update. You'll be surprised how many people fall off the bandwagon. Sometimes you get a pitch deck, and great, they're requesting a meeting. A lot of times what you need to just say is, this is not ready for me yet, get back to me in 3 months. And if you use any internal CRM in your emails, you'll see the numbers going down at least by 90%. So a lot of your initial pipeline should just be on email. So if you don't like something right away, don't waste your time. Just say not yet. And then if you really want to say yes, make sure that you have a solid attorney that you're working with. Let the founders know. This has happened. I once wanted to invest in a company, and I said, well, okay, I made my decision. It was 9 p.m. by the time I got all my numbers in from our associates and everybody, and I went to sleep, and the next morning, they'd already closed the round. I don't think that's going to happen. It doesn't happen in emerging markets because there's not as much competition. But if there is, let the founder know as soon as you have made a decision. Also, schedule a quick check-in with them. Every time you write a check, meet them in person. Meet them in person, define goals with them, and check back on those goals. Sometimes it's really hard to get information from the entrepreneurs, but it's as much your responsibility as it is the founders to get that information to you. And what if the round fails before I commit? Well, too bad. This happens to us a lot. Keep track of people in the Google Sheet, keep updating it, and make sure that you get back to them whenever. And Year 2 is kind of when a lot of your companies, if you invested in, begin to run out of money. So like you were talking about before, that's where your follow-on investments and everything comes in. Founders with strong companies are going to raise another round. Pick those. If you see a company failing drastically in 2 years, and you've been following up with them, and you've been working with them, don't try to save it. That is one of the biggest pitfalls of an angel investor, because you've invested your hard-earned money into this. You want to save them, you want to see them through. 90% of your investments are not going to pan out. Help the ones who are raising a follow-on round or ones who are on a growth trajectory. Excuse yourself from the ones that are not, and don't fight the lost battles. Very hard to do, but if you're continuously following up with your investments every 2 to 3 months, as an early stage investor, even if you're getting monthly updates, that's actually not too much. So if you're getting monthly or quarterly updates, by year or year and a half, you'll know if they're worth fighting for. Don't fight for the ones that are not. And then bridge rounds, again, you can either help them bridge the round themselves or look around in your network. Now, if you've written a deal memo, if you've followed their success around, it would be very easy for you to sell this company to the next investor. A lot of investors say, well, I invested in this company early, why should I be helping them now? Well, you're going to be making a 100x return on this company, so help them close the round, help them succeed, and you can help with bridge rounds as well, build partnerships while you're at it. Just one more point while I'm on this is so what should be your investor to entrepreneur meeting ratio? Any ideas? How many entrepreneurs you should meet versus how many other investors? 1 to 10? No, it's actually 2 to 10. So at least meet 2 other people in your network every week. And that does not mean going to a networking event, because everybody's just yelling and nothing happens. So go out for them for coffee, discuss the market with them, discuss opportunities with them, and these would then be the people who would help you in the bridge rounds a lot. So when you're doing follow-on investments, very important. If you're going to put money in somebody again, make sure that you know what has changed from the first time around. Make sure that you get pro rata. Make sure that who is pricing this round. A lot of times what happens is that when institutional investors come in, institutional investors want to price the round, which kind of screws the angels and the early stage investors. But if you have a good relationship with the founder, they will help you through that. So that's another thing to consider. Then, how many of the existing investors are participating? So let's say there were 5 investors in the early round, and you're the only one who wants to follow on. Find out why the other 4 are not doing it. Don't assume that it's not a company worth following on, but do find out why they're not doing it. And early stage founders get into a lot of fights and would have a lot of times when you would have to hold their hands. Ask them what's going on, is there anything I should know about, and help them through these problems and help them solve these problems. And these are kind of in different types of investment theses. And as an early stage investor, you need to find out why you're investing. So for example, I invest in technologies. I don't invest in, I even look at people, but I'm more interested in technologies that are going to have an impact. But somebody like Tim has a good mix of people and technologies. Or do you want to bet on problems? I want to solve the government problem. I want to solve education problem. And then within this problem, I'm going to invest in different verticals of that problem. Or I'm going to delight or experience. I'm going to invest in products that provide a different experience. So if you're going to be investing in hardware, especially VR, for example, is a hot industry right now. So that would fall under delights. And markets. Markets can either be industry vertical or geographic. So find out what your investment thesis is and stick to that. Don't invest 1 in one thing and 2 in another thing, because 2 years down the lane, you're not going to know what worked. That's also an investment thesis, by the way, where you just do like how you gamble. You just kind of keep putting money in, and one bet might make it big. That's also a way to do it. If you have a lot of money, do that. And then if you're selling shares and this is what you make money, one of my favorite sayings is that I actually asked an investor, I was like, how did you get so rich? And he said, by selling early. And that's a very weird kind of an answer, like how do you get rich by selling early? But if you're an early stage investor, by year 5 or 6, if another like a series A or B wants, you can start selling some of your shares, again, depending on how good the company is doing. But one of the biggest way of making money is to start selling shares. And if the company is going IPO, you obviously make a lot of money. But emerging markets are very early for that. I would be happy to take any questions. We actually only have a minute left, so I would be around for lunch if anyone of you has questions, or you can email me at asra@draperuniversity.com, and I reply to all of my emails. All right, thank you so much. Thank you. I completely missed